Wondering how to pay yourself through an LLC? It depends totally upon what's your corporation structure. It could be different for the draws for ownership, sole proprietorship, and it could be salaries for corporation. So I will explain everything in this video from starting till the end. So stay tuned. So let's start with sole proprietorship. How does a sole proprietor pays get out the money from his business? Well, to introduce how the sole proprietorship works is to understand this first of all that you don't really need to register your company with the IRS or any other authority. You just need to start your business, and the legal structure of your business would be just the same as you have. The owner's assets are the business assets, and owner's liabilities are similar to the business liabilities. You are the business that will be there. So if you earn any income from there, from that ownership of the company of the business, let's say you run a store and you haven't registered a business, so you are regarded as a sole proprietorship. If you want to withdraw money from your business, you can do so by that, but you will not be taxed by the amount of withdrawals that you made from your business. You will be taxed based on how much profit you had generated from that specific business. Totally depends on that. Let's say you made around $50,000 in sales and your expenses around $35,000. So net profit is $15,000. That will be the amount on which you are paying the individual income tax. That will be part of your individual tax returns, which will be filed using a 1040 form. And if you are running a sole proprietorship, it will be part of a Schedule C, and you might need to be paying the self-employment tax, of which is around 15.3%. So for the partnership, it's like teaming up for more than one person as an owner to run a business. So it's like 3 to 4 persons combining together have shared ownership of a certain business. So if you are running a business who have more than 2, 3, 4, 5 owners, that is regarded as a partnership. So the amount of profit, the amount of capital that has been invested in that type of business will be divided based on the percentage of ownership and percentage of profits that you have decided with each other to split that between on. So if you are running a partnership business, you want to withdraw your money from that business, then it will be equally divided based on the percentage of the ownership that you have. So it totally depends on the profits that you had made for a business and the dividends that you are withdrawing from your business. So let's say if you have three partners, 33% each partner holds ownership in the business, and that would be part of that. Let's say you want to withdraw like $100,000 from a business. So each partners can withdraw 33%, but make sure you have enough profit and enough cash for you get you the withdrawal of that amount. If you are running an S corporation, not an LLC, not a sole proprietorship, not a partnership. An S corporation is one of the most common business structure that a lot of business owners want to own. The reason behind that, you can take salaries from your business and you can save around 15.3% of the taxes on the total amount that you are withdrawing. So if you compare S corporation with an LLC, you would see a clear difference in taxes that you're gonna pay as a business owner. So 15.3%, which is a self-employment tax, which will be saved by you if you are running a self-employment business, if you're using an S corp rather than an LLC. And if you want to withdraw that amount of money, you are still getting option to withdraw your salaries, and you can also do some withdrawings on your behalf. And the amount that you're going to pay as a business owner will depend upon how much profits that you made, because S Corp need to file 1120S along with K1. S Corp itself doesn't pay any taxes. What does the pay taxes? The owners will be paying the taxes on the amount of the K1 that they are getting from the S Corp. So it will be taxed on the individual level, but you are not getting taxed based on how much distribution that you got from your company. So that's what an S Corp is. So let's move towards the C Corp. So if your business is very big, if you can see these large companies like Apple or other big corporations like Dell, these structures of these businesses are most of the common structure are C Corps, because these companies have different ownership and the management of these companies are quite different. So this is where the double taxation comes in, because both the owners and the business pay their own taxes. And if you want to withdraw the money from your business, then that will be the part of the dividends that owners can take the money out of your business, because the ownership of those businesses depends on how many shares they want to hold. So the last thing which is left is LLC, so limited liability company, which is one of the most common after an S corp in the US, that you can register your company as a liability company, which limit the liability of the ownership of the business, which means that if you made a loss or you need to pay some suppliers some money that you hold from them, you get a limited liability protection from your LLC, and you have an option to add in as many owners as you like and make it a partnership, or you can convert your LLC into an S corp. You can tax regard your LLC as an S corp. Okay, so that totally depends upon you. And if you want to withdraw the money from your LLC, you can do so, but you will only be taxed based on how much profit that you have made. So I hope you understand everything in this video, and make sure to like, subscribe and leave a comment, and see you in the next video. Thank you.